When people first hear about Islamic finance, they often ask, if charging interest is prohibited, how do banks make money? The answer lies in a number of unique instruments that comply with Islamic law. One of them is Murabaha. Murabaha is a financial instrument used widely across the Islamic banking system. But unlike a conventional loan, it doesn't involve lending money with interest. Instead, it's a cost-plus-profit sale contract. It resembles the purpose of trade credit in regular finance, but the methodology is totally different and rooted in ethical principles from Islamic teachings. In this video, we'll talk what Murabaha is, how it works, how it compares with regular trade credit, and its role in today's global financial system. Let's dive into the world of Murabaha and see how Islamic finance offers a practical yet faith-compliant alternative to interest-based credits. What is Murabaha? Murabaha is a type of sales deal where the seller discloses the actual cost of a product or asset to the buyer, and then adds a predetermined profit margin on top of it. In Islamic banking, this transaction typically happens like this. The bank buys an item on behalf of the client, then sells it to the client at a markup. The key condition is full transparency. The buyer must know both the original cost and the profit margin. Instead of borrowing money to buy an asset, the client is buying the asset itself from the bank with a deferred payment plan. The payment can be made in installments or as a lump sum at a later date. Murabaha is not a loan. It is a sale, and this distinction is critical under Sharia law. The Islamic bank acts as a seller, not a creditor. First, the agency buys the items, then sells them to the customer like the original seller. How does Murabaha work in practice? Let's look through a simplified example. Suppose Ahmed wants to buy a piece of machinery for his small textile business. He finds that the equipment costs $10,000. However, he doesn't have the upfront cash to purchase it. Instead of taking an interest-based loan, Ahmed goes to an Islamic bank. The bank purchases the machinery from the supplier for $10,000 and then resells it to Ahmed for $11,000, payable over 12 months. That $1,000 profit is pre-agreed and considered halal, acceptable, because it's not interest, it's profit from a legitimate sale. The bank assumes ownership of the item before selling it, which means it also takes on risk and responsibility during that period, fulfilling an important Sharia condition. Key conditions for Murabaha: to be Sharia-compliant. To ensure that Murabaha remains within the limitation of Islamic law, some critical conditions must be met. 1. Transparency in cost and profit. The seller must disclose the original purchase price and the agreed markup. No hidden charges. 2. Real asset involvement. The bank must take actual ownership and possession of the asset before reselling it. This ensures the transaction is not just a disguised loan. 3. No additional charges for late payment. If the buyer delays payment, the bank cannot charge additional fees or penalties based on time, unlike interest in conventional systems. 4. Clear documentation. The contract must outline all terms, timelines, responsibilities, and rights of both parties to avoid ambiguity and exploitation. Murabaha versus trade credit, a tale of two deals. We can simulate the context with Meet Aisha and David. Both need a $10,000 sewing machine but don't have the cash for prepayment. David chooses a conventional bank, gets a loan, and agrees to pay back $10,000 plus interest over 12 months. Simple? Yes. But it involves interest, something Islam prohibits. Aisha goes to an Islamic bank. Instead of lending her money, the bank buys the machine itself and sells it to her for $11,000, payable in monthly installments. No interest, just a fixed profit margin. The difference? David gets money and pays interest. Aisha buys a product and pays a disclosed profit. Murabaha is based on trade, ownership, and shared risk. Trade credit is based on lending and interest. So while both solve the same need, Murabaha aligns finance with ethics, fair, transparent, and faith-compliant. The key distinction is that Murabaha is rooted in real economic activity, a sale involving ownership, risk, and transfer of goods. While trade credit often includes an interest component as compensation for time, in Murabaha, risk is shared. If the asset is damaged while under the bank's ownership, it suffers the loss. This is very different from conventional finance, where the lender transfers the full risk to the borrower. Main uses of Murabaha. Murabaha is one of the most practical tools in the Islamic finance toolbox. It is commonly used in home financing, buying homes with installment plans, Vehicle financing, purchasing cars with deferred payments. Corporate working capital, businesses buying raw materials or machinery. Trade finance, cross-border transactions involving goods. Because of its predictability and simplicity, it often serves as a gateway product for new Islamic banks or clients transitioning from conventional to Sharia-compliant systems. Advantages of Murabaha. Murabaha offers several benefits to both clients and banks. 1. Transparency. Both parties agree upfront on all costs, which eliminates ambiguity. 2. Fixed payments. Payments are structured and predictable, ideal for budgeting. 3. Ethical profit. The markup is justified as profit from a real sale, not interest on money. 4. Lower risk for banks. Because it's backed by tangible assets, Murabaha is relatively safer than equity-based Islamic models. 5. Widespread acceptance. From Malaysia to the Middle East to Africa, Murabaha is a trusted model across different jurisdictions. Criticisms and limitations. While Murabaha plays a vital role in Islamic finance, it is not without criticism. 1. Form over substance concerns. Some critics argue that Murabaha too closely resembles interest-based lending, especially when the asset transaction is only symbolic. 2. Minimal risk-taking. Banks often hold the asset for a very short period, reducing the real economic risk, which some scholars believe defeats the spirit of Islamic finance. 3. Limited wealth sharing. Unlike equity-based models like Musharaka or Murabaha, Murabaha doesn't promote true risk sharing or entrepreneurial partnership. 4. Overuse. Many Islamic banks rely heavily on Murabaha, sometimes for over 70% of their portfolios, which limits innovation and diversification. These criticisms are being addressed with regulatory frameworks, stronger compliance mechanisms, and evolving product structures. Murabaha in modern Islamic banking. Today, Murabaha is the most widely used Islamic finance product, accounting for a crucial share of global Islamic banking assets. It works well in conservative environments where fixed returns are expected. Murabaha allows Islamic banks to generate income, manage risks, and remain competitive without violating Sharia. Global banks like HSBC, Amana, and Standard Chartered Sadiq use Murabaha structures in personal finance, trade credit, and even structured finance products. In regions like the GCC, Malaysia, and Pakistan, Murabaha is also integrated into government financing tools and small business development programs. In Turkey, governmental-funded participation banks uses this tool effectively as well as the private-funded participation banks. In Turkey, participation banks can operate like a leasing agency for leasing tool. However, conventional bank can't operate leasing in its structural body. They must open particular leasing bank agency as a different legal entity. Murabaha proves that finance can be both practical and principled. It mirrors the benefits of trade credit but avoids the exploitative nature of interest-based lending. And in our next video, we'll explore Ijara, the Islamic leasing model, and see how it compares with conventional leasing practices. Until then, stay informed, stay ethical, and thank you for watching Islamic Finance Unboxed.